Welcome back to the Elevate Podcast from Burnout to Bliss. I'm your host, Reggie.
And I'm Ebony, and we are so excited to kick off Season 2 with you.
This season, we're diving even deeper into the mindset shifts, financial moves, and business strategies that help you break free from burnout and step boldly into the life you were meant to live.
And today, we're starting strong with rapid-fire look at the hottest trends in finance, business, and the economy. From AI to inflation to new investment waves, you don't want to miss it.
That's right. So whether you're plotting your next career move or looking to grow your money in this ever-changing world, we've got the insight that will elevate your thinking and your future.
Let's get into it. Season 2 starts now.
Starts right now. All right, y'all. So, hey, man, look, I just want to say as we get started today that a quick reflection on the first season. I'm so thankful and humbled by the response, how the first season went. When Ebony and I started to, make the decision to do this, we had no railroad tracks to run off of.
At all.
We were figuring it out as we were going. We're still figuring it out, to be honest with you. And just the response was great.
It was very good. And I want to thank all of the listeners and all of the people who tuned in every single week. Yeah, and even during our break, people were saying, hey, when a new episode's coming. So, hey, we want to say thank you all. And we're going to keep digging deeper and deeper to give the information and knowledge and the guests that we're bringing in to elevate your life. So, and we literally did not know what we were doing. So sometimes you just got to do it and figure it out along the way.
You just figure it out as you go, y'all. Progress does not require perfection.
That's true.
Don't forget that. So anyway, today's topic. So here's what we're going to do as we open up this new season. We're just going to kind of do a rapid fire of some of the hottest topics trending in the financial space, the economic space, and I think we're going to talk about the entrepreneur space today. So to get us going, Eb, let's just, what's one of the, as you and I are preparing for this episode, you told me about something that's really, really hot right now in the financial space.
Yes. So the hot topic right now in the financial space and in the stock space is the IPO of this company called Figma.
Figma.
So Figma is, if you were to liken it to another company, it's like a web-based version of all of the Adobe design products.
Hold on. Before we go further, let me spell it out. That's Figma, right?
Right. Figma. Okay. So Adobe has like Adobe Illustrator and things like that you can use to design logos and websites. Well, Figma has that, but it's web-based.
It's web-based. Okay.
So a lot of people are going from an application that you actually put on your computer to web-based applications. Right. So it's done really well in the design world. And July 31st, they IPO'd. The initial price was $33, which was understated. It is now trading for around $117. Okay. So it's the hot thing on the market right now.
So I got to pause right here, guys, and give you all full disclosure. Once I learned about this stock, I own this stock, and I have to let you know that as a certified financial planner, investment advisor, I do have to tell you that I do own this stock that we're talking about, and us reviewing this stock and talking about this stock is not a recommendation to buy or sell this or any other particular security.
Correct.
Right? Past performance is not a guarantee of future results, all right? So I do have to get that out there. So go ahead, I'm sorry.
And just want to add that so far, the IPO made the founders $1.2 billion with a B dollars. $1.2 billion.
So that's crazy. So, but let me do this, if you don't mind. Let me just tell them exactly what an IPO is.
Yes, please.
I don't want to assume everybody understands an IPO. So even the initials IPO, the I is for initial, the P is for public, the O is for offering. Basically, make a really long story short, the IPO is the first day that the ownership of the company is sold to the general public. All right. So if you think about it like this, let's say you started a private company, maybe you started a tech company or a clothing brand or whatever the case may be, and you decided you need more capital to operate with. And maybe it was you and a couple of buddies. Y'all started the business together. Well, y'all are the three owners. Right now it's a private company. And you may even have some other investors, but it's still private.
And so I want to clarify, just to be clear, when he says you needed more capital, he's saying specifically money.
Right. You need more money to operate with. Well, you got two choices. You can borrow the money, or you can sell some of the ownership of the company to other investors. So what an IPO is, this is the date that you are selling shares of ownership to the general public, not other just private investors. All right. And one thing to understand, here's a big misconception about IPOs. A lot of people say, man, I want to get on the IPO, I want to get in on the IPO. Typically what they're saying when they say, I want to get in on an IPO, they're saying they want to buy it early. They want to, as soon as it IPOs or as soon as it goes public, they want to buy it right then. That's their mindset of getting in on the IPO. Well, let me tell you where you really want to be on the day a company IPOs.
Where is that?
You want to be the person that's selling the stock that day, not the person that's buying it.
So that would have been the person or people that made the $1.2 billion.
There you go. These are typically the venture capitalists. These are the people that bought while it was still private. They are the big winners on the day that a stock typically goes when the stock typically goes public. They're the ones that win because, like you said, they're the ones that receive the $1.2 billion. That's who it went to. It went to the early adopters, the founders, the venture capitalists, all the people that sold it. I mean, that sold it on that day.
Right.
So when you talk about, having a goal of getting in on the IPO, that's where you want to be starting something yourself, taking it public, or being part of the ownership group that takes a company public.
And I get it. And like you said, what people are really saying is that they want to get in early
right.
on
That's
it
usually what
to
they're
catch
saying.
Because a lot of times there is an upswing after it IPOs. So they want to catch that before it kind of levels out and finds its place in the market.
And no doubt about it. Like you just mentioned, if Figma IPO'd at $33 and is now selling for what? You said
$117.
I mean, that's 3 times, the IPO price. So people that bought it at $33 are definitely sitting very well. They're just not doing as well as the people that sold it for $33. So hey, they still doing great.
Yeah. And you talked about why. So you talked about what happens when a company IPOs or what may motivate them, but what are some reasons why a company would decide to stay private?
Well, when you IPO, now you're a publicly traded company. There's a lot that comes with that. All right, way more scrutiny. Now you're responsible to the SEC. You're responsible for the particular exchange that you're trading on. If you're on the New York Stock Exchange, it's certain reporting requirements based on the platform you're trading on. So people may choose to stay private because they don't want to deal with all that. And with all the responsibility comes extra money. You got to pay people to keep you compliant with every level of oversight that comes with that. There's more people involved in ownership. You may not want to have to deal with because every common stockholder has voting rights.
Sure.
So you may not want to have to deal with that. You may not want to have your board picked by the shareholders. So it's a lot that comes with that, with being public. And I'm going to give you an example. Dell Computers was public. Then they went back private. So companies do that. It's called delisting. That companies will delist their shares. So you see it now. You see more companies going from private to public than you do public to private, but it does happen.
And I do want to add that when companies go public, they don't sell all of the shares.
Not
so
at
the
all.
owners still have shares in the company.
Absolutely, and typically they're going to retain the majority of the ownership. Right.
Yeah, I read that the founder of Figma, they still have 74% of the voting shares.
Okay.
Yeah.
Now, let's talk a little bit more about Figma because it definitely, obviously, again, I do own this stock, y'all, so I have to disclose that. But as I was learning about it, now, from what I understood, Adobe had the opportunity to buy them when they were still private.
They did. The regulatory body in the UK felt like it was there wouldn't be enough competition, so they rejected Adobe's offer to buy Figma.
So Adobe, at this point, would be one of their biggest competitors.
Correct.
All right. So that's something to think about. And things you should be concerned about with purchasing an IPO, you should be concerned about, as Ebony just mentioned, the big price swings. So now it's gone up from 33 to 117. But again, IPOs have to find their place in them. It's a new stock looking for its value in the market. And the value is determined by buyers and sellers. So you're going to see a lot of volatility in those early days. I remember when, what's the company? The platform, Robinhood. I remember when Robinhood IPO, and I remember I was a guest contributor on a news station that asked me my thoughts about it. And I looked into it. I said, it's not going to do good at the gate, and it didn't. Now they have turned it around, and this, the stock has done very well. But out the gate, it did not, and I knew that it wouldn't.
Facebook didn't either, if you remember.
Facebook did not either. So again, when a stock first hits the market, again, it searches for its value by the number of buyers and sellers. So if you're gonna hitch up to that, be prepared for a roller coaster ride until things start to level off. And
there's a whole team of people before a company IPOs that help determine what the initial price is.
It's exactly right. You know what? I'm glad you said that. So anyone listening, looking for a career change, or maybe you want to spread this knowledge to a younger person and maybe starting out, the team of people that help determine where a stock should IPO at, that's an investment banker. That's what investment bankers do. All right, and they underwrite the stock. Sometimes they get other companies involved, but based on their analysis, based on the earnings, based on the segment, a lot of factors, they tell the founders of the company, hey, this is where we think this stock should come out at the gate at. This is where it should IPO at. Now, you think about this. When you think about that, Figma IPO'd at 33. Immediately shot up 3 times the amount. So clearly, they could have IPO'd much higher.
Correct.
And the founders could have got $3 billion. Because they didn't price it right. So in a perfect world, if the investment bankers get it 100% correct, the day of stock IPOs, it'll just kind of float around their value, because that's where it is. But if it takes off, that means that the founders really got a little shorted. And if it tanks, that means that the buyers definitely got shorted on that too.
Right. So I want to make sure everyone understands. So when that let's go with that same $33 price.
Okay.
For that, so the owners of the company, the initial investors of the company, they got the $33 times the number of shares that were sold. And I think it was 36 million-ish shares were sold. Anything from $33 to $117, where it is now, those are individual investors or non-investors that aren't related to the company.
Right.
Those are the people that earned that money, that made that money. Yeah.
And then when a stock trades, so that's called the primary market. And then when you purchase a stock after it's already went through its IPO phase, that's the secondary market. So when you buy and trade a stock just on the open market, that money does not go to the company. Right. So if you buy Microsoft stock today, that money is not going to Microsoft, okay? It's going to the person on the other side of the transaction that sold it, all right? So the money only goes back to the company during the IPO phase in the primary market.
Right. Like if you buy a used car, the money's not going to Ford. No. It's going to whoever owned that used car.
Jim's used Ford lot.
Right.
It's going over there. Another thing, so again, we just found this a very interesting stock to watch. One that I'm hoping does well, clearly. But the fact that I would be concerned about the volatility. I am concerned about the volatility, but again, I can stomach it. So make sure if this is something you decide to do, make sure you can. But also the fact they got some pretty hefty competition. Adobe obviously is a competitor now. Microsoft is a competitor. These companies have really deep pockets, and the innovations in AI is allowing them to catch up with some of the things that Figma is already able to do. So just got to always watch your competition and see if they can adapt.
So another trending topic, I was reading a Reuters article.
Okay.
And it was talking about the global dominance of the U.S. dollar and its competition.
Okay, you got to talk to us about that.
So picture the U.S. dollar like king of the global economy. So all of the other economies, all of the other countries measure their dollar based on our dollar.
Okay.
So you may go to a company with you may go to Mexico, and it may be $1 US to, I don't know what it is right now, but it may be 17. That means that our dollar is stronger.
Right.
Well, what's happening is because of the current state of our economy and tariffs and trade relationships, these companies are starting to do business. I mean, these countries are starting to do business with each other and leaving the U.S. out of it.
Okay.
So what can happen in turn, although the U.S. dollar is still the strongest currency in the world, it's going to give more strength, and those other currencies will become competition for us.
Okay.
Because two countries can do business with each other and leave the U.S. out of it.
Right. And that's the talk that I hear around whether or not the dollar will remain the reserve currency of the globe. My personal thought is that right now, I think the dollar is still firmly the reserve currency, but it could change, and if it changes, then our way of life changes with it. So that'll be something that people need to kind of tap into and watch. And just kind of see what happens.
Yeah.
But
because right now, both Europe and China are trying to make their currency an international currency.
And the euro's already stronger than the dollar. Very interesting stuff. Well, another thing I want to talk about, trying to squeeze in this first segment, and that's a hot topic right now, is around the interest. Crypto is making a strong comeback, as well as gold. I'll speak to the gold thing real quick. Gold, I see a lot of conspiracy theory type stuff concerning owning gold. And I'm not going to deal with all that. But what I will say is that precious metals, including gold, has been traditionally been a good hedge against inflation.
Okay.
And we're going to talk a little more about inflation in just a little bit. So when inflation rises, the ownership of a real asset such as gold is typically a very good hedge against that and has a place in a well-diversified portfolio. I've seen some people take all their money out and stick it in gold or other precious metals. Now, and one issue with that is this. If you own gold, think about this. There's only one way you can make money off of it, and that is to convert it back into cash. You buy low, sell high. You don't get any dividends off of it.
True.
You're not none of that. So it's not like owning a piece of real estate or common stock or cash value life insurance where you can earn dividends. The only way you're going to get some money back off of this, you have to convert it back to cash.
So you either hold it or you sell it.
That's your only two choices. So it has a place in a well-diversified portfolio, but I would never encourage anybody to put all their money into that one asset.
So aren't there securities that have gold in them?
Yes, like ETFs and things like that. So, yeah. So, again, it has its place, but not solely in that spot like that. But, guys, we got to get out of here for just the first segment. Make sure you stay with us through the break. We're glad to be back on the air with you guys. Remember, it's time to elevate.
So now we're going to shift the conversation over to the economy. So, Reggie, this is more your area. So what's moving the needle on the economy right now?
Okay, well, the economy, first let me say this. The economy is actually doing very well, believe it or not. Now, there's some cracks, but there's always cracks. But what's moving the needle right now is inflation, and I definitely want to talk about that. Interest rates. And most importantly, probably what's the biggest thing that's keeping the economy strong is what we call consumer confidence or discretionary spending.
Okay.
And specifically what that is everybody's still spending money. And as long as consumers are still spending money pretty heavily, the economy does well. And right now, that's probably the best bright spot out there in the economy right now. Now, we will talk about what's threatening that. But right now, as we sit today, people are still spending a lot of dollars.
Got it. So what is threatening it?
Well, I don't know if you all saw what happened on Friday, just on Friday, a couple of days ago. The tariffs. The tariffs are the biggest threat right now to the economy. And again, I've said this before. I say it a million times. Anything I share publicly, either on my social media platform, this podcast, I don't care what side of a political aisle you sit on. This is not a political talk. I don't get into politics publicly. That's not my lane. But I do have to talk about politics sometimes as it relates to finance.
Right.
Okay. So right now, the biggest threat is 100% what's happening in the tariff space.
So I did see that the tariff for Canada is 35% now.
Yes.
It was up from 25%, and then the government imposed a 50% tariff on Brazil.
Yep.
and a 50% tariff on some copper imports.
Right.
And then some of the other deadlines for the other countries, that's been pushed back to August 8th, I guess, to give them time to negotiate.
Right.
And so we'll just have to see what those end up being. But 35% for Canada and 50% for Brazil, those are the highest tariffs we've seen as a country since the 1930s.
Exactly. And I want to help the listeners. If you don't already know, I want to make something painfully clear. Other countries do not pay tariffs for the goods they send to this country. Mm-hmm. They don't pay them. The tariffs, and we talked about this in the first season, the tariffs are paid by the company that's importing the goods here.
Right.
All right? So, for instance, if you buy yarn from China to make whatever you make, pillows or whatever you make out of yarn, the cost to get that yarn here has now increased. So now you got two choices. You can absorb that hit yourself.
Mm-hmm. And you're saying you as in who has two choices?
You as the manufacturer.
Okay.
You as the manufacturer, you have two choices. You can absorb that hit yourself, or you can pass it off to your customer in the form of a higher price. Mm-hmm. So here's the thing you got to understand about the tariffs. Right now, year to date, the government has raised $125.6 billion just off tariffs.
Wow.
Now, you think about that. That means that there's $126 billion more that has been paid already just to get raw materials and goods over into the country. Mm-hmm. So you may say, well, Reggie, why haven't we seen a climatic rise in prices as a result of this? Well, to date, so far, the major importers, your bigger company, Amazon, Walmart, companies like this, they've taken the brunt of the hit from these tests. As a matter of fact, Amazon stock just went down because they missed their earnings, because they have been absorbing as much of these tariffs as they possibly could. Well, they've sent out a very clear message, and what they've said is, we're done. We've taken all of this we can take. We're about to pass these prices on to the general public, and now everybody's going to share in this tariff thing.
I want to add this. So, in theory, when tariffs are what's the word?
Negotiated?
Not negotiated, but implemented.
Okay.
I can't think of the word I'm talking about right now. But when there are tariffs imposed on a country, in theory, it is to hurt that country.
In theory, or to create trade balance, what's called trade balance. But go ahead.
But what happens is sometimes we think about tariffs and we think about products coming into the country, into the U.S. as complete products.
Right.
But there are U.S. companies that get some of their raw materials from other countries.
Correct.
I.e., Canada supplies a lot of our aluminum.
That's right.
There are American companies that make canned drinks, canned beer, things like that, and they get the aluminum from Canada. So even it's still hurting this American company. If the idea is to buy American, that company is still being hurt by those tariffs because the U.S. can't supply the aluminum, all of the aluminum that those companies need.
Exactly. We don't have the raw materials in every segment of the economy to produce everything here in the country. We don't have the raw materials. We don't have the skill set. We don't have the infrastructure.
We don't have the climate.
We don't have the climate. There's a lot of things we can't do. That's why we're part of a global economy. All right? So there's no way tariffs are going to not affect the American people in your pocket, right?
Correct.
So, and again, what has held back the tide to date are the deep pocket companies taking all they could take. But they have shareholders they got to answer to. And the shareholders are saying, hey, you're going to have to pass these prices on because I don't want my stock devalued because y'all are paying the cost of these tariffs. Just pass it on to the customers. And that's where we are now.
So we kind of talked about it a little bit already, but who's benefiting and who's hurting from these tariffs?
Well, who's benefiting right now is the U.S. government. Because right now, again, you're talking about $125 billion has gone into the coffers of the U.S. Treasury, which I believe is an offset toward the tax breaks to the wealthiest people in the country. So right now, clearly the government has benefited. Now, who's hurting is going to be, well, who's hurting right now? Some of the manufacturers are hurting. We've seen businesses go completely out of business already because they just can't compete. So manufacturers are hurting right now, but who's about to hurt is going to be the economy, the American economy at large, unless some of these are walked back. But even with that, let me say this: even when you walk that back, here's where it becomes very difficult, especially in the investing world that I sit in. It's hard to forecast. It's hard to when you can't when policies literally change overnight without any indication. You just wake up and all of a sudden
things are different.
Yeah, you wake up to a whole new global trading world. It's hard to forecast, so it makes investing really difficult. So who's hurting now? Manufacturers, some domestic manufacturers in the country, countries who need to sell their stuff here, but who's going to be hurting if something doesn't change is the American people at large.
And another thing to note, if prices are adjusted to account for tariffs, like the retail prices are adjusted, even if the tariffs get walked back, the prices are not going to go back down at the same rate that they rose.
No.
That's just how it happens. Because you get used to, the consumers get used to paying it.
Case in point, do you remember back when, I know you do, back when gas prices shot up really high, all the airlines said, hey, we got to start charging for the bags because the fuel price is so high. Fuel price been down. And they ain't got rid of that yet.
And Southwest added a baggage fee.
There you go. So very rarely do the prices go back the other way after the whatever caused them to go up has gone away. Only thing can drive prices back down is competition. That's why competition is good for the consumer.
Yeah.
But in a closed industry like the airline industry, if they all say, hey, we're keeping bag fees, nobody's, then, hey, there ain't no competition there.
Yeah.
Bag fees just stay there.
Right. We're just paying bag fees.
We're just paying bag fees.
So what are some other notable economic things going on right now?
Well, so you may have seen, again, last week, the Federal Reserve with Jerome Powell as the chairman decided not to lower interest rates. This was big. This was very big because he's been receiving a lot of pressure from the White House to lower the rates. Well, and so this is the fifth meeting in a row where rates have stayed the same. And I would say this, in certain parts of the economy, I'd like to see lower rates. I'd like to see lower mortgage rates, which the Fed funds, the rate that the Federal Reserve controls is not the same as the mortgage rate. But anyway, there's parts where I would like to see, I got houses I want to sell, right? But right now, and so here's his thought process. I'm going to try to make this as clear as I can. They decided to leave the rates the same because when you lower interest rates, that means people can borrow money at cheaper rates. That puts more money in the system, which allows people to spend more money, which leads to inflation. Okay? That's what happened after the pandemic. Low rates, all the extra money led to inflation. Well, what the Federal Reserve stated is they're really concerned about what I just talked about, the floodgate of the high prices due to the tariffs. So what they're saying is if we lower rates now, that leads to inflation. If all these companies open up the floodgates to higher prices because of the tariffs, that leads to inflation. We could be in a bad place. Hyperinflation. Go back and look in history. You'll see back, now I don't think nothing like this will happen here, but I remember from history lessons during World War II, it took a wheelbarrow of money, German money, to buy a loaf of bread. That's how bad inflation was.
That's crazy.
And by the time they got there, it needed a wheelbarrow and a half, So now I'm not predicting nothing like that, but I'm just saying, very extreme case. However, that's the Fed's thought process, on interest rates as it relates to the tariffs right now. And the White House is pushing really hard for lower rates. But I think they're doing so without a full understanding of how the economy actually works. Right.
So I will say that economics is a very, very complicated and deep topic and subject, area of study. So while it's easy for people to say, oh, I want rates to be lower because they want to pay a lower rate themselves, that doesn't always translate to what's best for the economy as a whole. That's exactly economics Just in case you're wondering, economics is not a simple topic.
It's not. I'd love it, though. Matter of fact, if I could go back, that's what I would have got my degree in because it's more broad than finance degree. one more thing I want to add, and we got time to get this in. Actually, we got time to get a couple of things in. That is, I mentioned that sometimes people say, well, I wish they bring the rates down so mortgage rates would go down. I want to take a quick second to help educate the listeners on that. The rate that the Federal Reserve Board controls is called the Fed funds rate. That rate is more closely aligned to your credit card rates, your HELOC rates, and things like that.
Okay.
It is not a direct correlation to your mortgage rate. If you want something to move the needle on your mortgage, you need to be looking to the 10-year Treasury.
Okay.
All right. That they tie mortgages to the 10-year Treasury yield. Okay. So that's what you want to watch for that. So sometimes when the rates do move, people all of a sudden say, "Oh, now mortgages were going down." No,
not necessarily.
No. And here's another thing to keep in mind: if you are really pulling for interest rates to go down, what you're really saying is, I want the economy to get bad so that the Federal Reserve will lower the rates. Because them lowering the rates is giving the economy medicine. And you don't take penicillin if you're not sick.
Right.
All right? You don't take, all this other stuff if you're not sick. So they don't lower the rates until the economy is sick.
Right.
And I just told you.
to stimulate the economy.
It's to stimulate the economy. And I just told you in the first segment, the economy's doing pretty good.
What are some economic things going on in the housing market?
So right now in the housing market, you're starting to see the market get back into equilibrium. What I mean is it's not a buyer's market right now. It's not really a seller's market. It's kind of the best negotiators market right now. It's a lot of inventory on the market. Houses are sitting out there longer. I'm on the board of equalization for Shelby County, and one of the things we've seen is actually in certain neighborhoods, prices are actually trending downward.
Really?
Yes, from the pandemic. Remember people buying the houses and they were paying, $30,000 over asking. Well, that's starting to bite some people in the butt because the interest rates were so low, people were just paying anything to get into a house. Well, now we're starting to send people values trend lower than today. Not a lot, but lower today than where they were when they purchased it. So that's very interesting. So right now, again, it's more equilibrium in the market right now. More inventory is lasting longer, which is typically good for the buyer. But people are, the sellers are doing pretty good too. It's just now the seller may have to offer more concessions. But when interest rates do tick downward, there should be plenty of shopping to be done.
So going back to the fact that in some neighborhoods the price is trending downward, so that affects that person's equity in the home. So can you talk a little bit about that?
Yeah, so equity in your home is the difference between what you owe and what it's worth. So if what is worth is decreasing, then so is your equity or your ownership in the property. And again, we're not seeing it on a large scale, but in areas where people overbought, when people were paying those exorbitant and kind of exuberant fees over asking just to get in, that's where we're seeing it happen. So just the other day, we saw a case where a lady, she pled her case to the board, and the data showed that she was actually right. The values in her neighborhood are actually a little less than where she bought. Wow. Just 2 years, I think 2.5 years ago. So, yep. So, guys, that segment went fast.
It did.
So, stay with us one more time through this break. This is great conversation. Hope this is helping. I know it is. Hope it's helping somebody. But we'll be right back in just a minute. Remember, it's time to elevate.
Today's episode is sponsored by P3 Financial Group, where we enrich the lives of our clients by helping them plan, protect, and prosper. Call P3 for all your tax and financial planning needs at 901-209-4015.
So, y'all, for this last segment today, I want to shift the conversation one more time. I want to talk about, Ebony, some of the hottest trends that we're seeing in the business entrepreneurial space.
Okay. So one trend that I'm seeing right now is that there is an increase in the number of solo founders of businesses. So a kind of name for that is a solopreneur.
Okay.
That means someone who started and is building a business by themselves.
As the founder.
As the founder.
It don't mean they're the only one working there.
It doesn't mean they're the only one working. They may have employees, but there's no one that they're collaborating with and building the business with.
So it's not a team of people doing it.
Correct.
Okay.
Which sometimes in our community we see a lot of that, but in the business entrepreneurial space as a whole, most businesses have traditionally, it's been a team of people starting a business.
Yeah. Okay.
But there's been a 35% growth in solopreneurs. Like if you look at all of the new incorporated businesses in 2024, there was a 35% growth in the ones that were solopreneurs.
Okay.
And although there is an increase in solopreneurs, usually venture capitalists. So a venture capitalist is someone kind of behind the scenes that will invest in a business.
Okay.
They're not
early investor.
An early investor. They're not involved in the day-to-day operations.
Okay.
And usually venture capitalists bend toward teams of people building a business
as opposed to one person.
As opposed to one person, because they want to hedge their bet and rely on the brain power and the skill and the work of multiple people. But there's also been a 17% increase in the amount of venture capitalists that have invested in solo businesses.
Okay, so what's driving that?
What's driving it is AI.
Okay.
So instead of it requiring my brain and your brain and his brain and her brain, it's been one person being able to leverage AI as almost like their business partner to be able to build the business and go a lot further than the brain power of one or two people. So it's interesting.
It's very interesting.
AI is not new, but each day we're learning how to use it more. And the more we use it, the more we can leverage it and see what it actually can do.
And it is, it's not brand new. It's not, in the embryo stage, but it's new as far as the general public starting to adapt it and adopt it. So I just, obviously Ebony knows this, but here at our company, P3 Financial Group, we had a day of a training session just last week.
We did.
On just an introduction session, if you will, for our staff and team members to get better acclimated to AI, Chat GPT in particular, but it's a lot of other ones out there, Gemini and there's other ones.
Copilot. It's tons.
There's tons of them out there. But the way I explained it to the team, I said that if you're having a mental block or you having some sort of something that's hindering you from walking down this AI road, it's the equivalent of being in the mid to late 90s saying, you know what, I'm going to sit this internet thing out. I don't want to learn the internet. I'm just going to kind of keep doing things the way I've been doing it. And you're going to look up and the world will have passed you by because you decided to, sit this one out as far as the, most exciting piece of technology that's come across in decades.
Right. And there are a lot of people that say AI will make you dumb.
Yeah.
It depends on how you use it. So it's not necessarily making you dumb. It can make you more efficient. So instead of you spending time writing a press release,
right,
you feed AI a general summary of what you want the press release to be about and hit the button and you have a press release. So that's 40 minutes that I may have gotten back that I can spend on things that AI can't do. Because AI can't do everything.
And when you talk about, that's exactly right. It's a good example too. When you talk about being more efficient, what I had to learn in business. Now, if you're running a business right now, I want you to lean in close and listen to this. You need to write down the activities that it takes to generate revenue. All right. So separate the revenue generating activities from the support activities. So many times we spend so much time on the support activity because it makes us feel busy. And we're leaving the revenue-generating activities undone, or we're not doing a great job at them. All right, so you have to see, and if you're not the greatest revenue generator, you need to bring somebody in. But if you're not, but if that's all you're focusing on, and you're leaving some of those support functions done, this may be an area where AI can assist with that.
True, and that's good advice whether you're utilizing AI or not. You, as a business owner, or as an employee, whatever you are doing, you have a set of specialized skills that only you can do.
Right.
Because even if someone has the same job title as you, even if someone has the same education as you, they can't do it like you because there's only one you.
Correct.
So let's work and focus on those things that only you can do, and let AI or someone else outsource those things that other people can do to them.
Exactly. And I'll say this. I was a little slow to warm up to AI. Not that I was fearful of it. I mean, I grew up watching Terminator. So, you always got that in the back of your mind. Is this Skynet and all this kind of stuff. But what we did here, I went out and I found it's tons of videos out there on YouTube that can help acclimate you to ChatGPT or some of the other ones. I kind of focus on ChatGPT. It's probably the one people recognize the most.
Right.
But we found a good one about 30, I think it was 30 minutes, an hour long.
No more than an hour.
Yeah, but we walked through it. We followed the lady's instructions. Very good information on as far as learning how to prompt AI to give you back the best results that you're looking for. It can do way more than just, being a substitute for Google search. I'll say that. Way more than that, man. And it really, it's just going to hit you with some wow moments. You're like, yeah, doggy, that was really pretty close to the, hitting the nail on the head as far as what you were looking for. So, I just encourage people to adopt it.
Me too. And AI can absolutely be your business partner.
Sure can.
Absolutely.
There
are people that start businesses using AI. There are people that give trainings on how to start businesses as using AI. There are faceless pages. I mean, you can feed all kind of information into AI, and it can absolutely be your business partner.
It really can. We believe in it so much, guys, that what we've done, I have offered to my team members, my employees here, I will pay for a certified ChatGPT professional certification. And not only will I pay for the class, I will pay them to get it.
Wow.
Now, today, ain't nobody took us up on the offer, but it's out there. And also, I told my daughters, if you all get this certification, I will pay you for it because I want them to be on the cutting edge of what's coming. I don't want this to pass them by. I'm not relying on the school system solely to get them, deep into this. I got to encourage them to do it. We got to do that ourselves because I see that everything is going this way. So they need to be. I want them to understand it better than I do. I plan on getting a certification myself, but I want them to be, well more advanced than I am in it.
Yeah, that's true. So going from that, when we were talking about being more efficient and which can lead to having more time, there was an Economic Times article that talked about how entrepreneurs are embracing more stillness and mental clarity. So to couple the hustle, they are spending an equal amount of time on their own or with mindfulness and self-care and things like that. And I think that AI can help with that.
It can.
So if I'm saving 3 hours a week because I'm having AI do some of these automated tasks, or because it's not just about, like you said, a Google search, putting something in Google and getting something back. You can set up AI prompts to automate some of the regular everyday tasks that you do.
Right.
So say you get 3 or 4 hours back. That's 3 or 4 hours you can go to the park and ride your bike. 3 or 4 hours you can go get a massage and just have that downtime and have some me time and self-care.
Exactly. The way I explained to someone who said, well, it's going to make you dumber, I said, well, you think about this. When cars came on the scene, they replaced horses. So with that transition, there was a knowledge lost on how to shoe a horse, how to care for a horse. But that don't mean we're dumber. It just means we shifted the energy people were using to care for horses.
Right.
They were able to do something else with it. Instead of it taking a day and a half to get from Memphis to Nashville, now you're doing it in 2.5 hours.
Right.
So it's not I don't think it's a dumbing down of society. It's a shifting of efficiency and collection of knowledge.
That's true. Well, Reggie, that's almost our time. So before we get out of here, let's talk about some things going on at P3.
Yeah, we don't do that enough. One of the things that we got coming up in September, actually it's on September the 14th, we're having our very first P3 Picnic and Family Day, or Family, I don't know what it's called. But it's
Picnic
P3,
and Family Day.
Our P3 Picnic and Family Day. Last year we did our second holiday party for all our clients, but that was adults only. for the most part. So we decided to do something for the entire family.
Yes,
so
it's going to be fun.
It's going to be really fun. So if you're one of our clients, you should have received an email with no cost to you guys with all the details. If you have not received that email, go ahead and give us a call, because right now we already have over 300 clients registered to come out, hang out with us, have a good time. That's going to be great. And also, if you're a business owner and you would like to be a sponsor of that event, if you would like to put your business, your message in front of a very engaged client community, reach out to us. You can email Ebony at EBONY at P as in Paul, the number 3, financialgroup.com. That's Ebony at p3financialgroup.com. We're gonna have it's going to be a fun day that day.
It's going to be really fun.
It's going to be real fun. We also have, in addition to the P3 Family Day, we have a seminar coming up.
Okay.
And I'm excited about this. It's called Staking Strategy, How the Wealthy Leave Wealth Seminar.
And this is a new seminar for us.
This is a brand new seminar. I've never done this before. I came across some information, and I'm not new to that information, but it's an extremely powerful way to create wealth and pass it on to the next generation. So this seminar, I want to be very clear, this is something that's different, and what makes it different is it's not for everybody. It's very niche audience, and specifically it's for people. First of all, you got to be over 45 to attend. You need to have at least $100,000 that you've earmarked to be left as an inheritance. So this is about leaving a legacy. And you also, you need to have it outside of a retirement plan. It don't need to be. It could be an investment account, savings, annuity, somewhere like that. But it cannot be in your employer's retirement plan.
Your current employer.
No, it can't be in your 401k.
Yeah.
And I'll say this. So it's going to be primarily about leaving a legacy. How do we magnify the gift? How do we get it around the IRS? Legally, and how do we get it to that next generation? We've talked so much about building wealth that it's time, and I'm talking we as a community. We've gone from just surviving to thriving. We talked about building wealth. It's time for us to shift the conversation to how do we get the wealth that we are accumulating in this generation? How do we get it to the next generation so that they aren't starting off in the parking lot?
Right.
They're at least on first base. And we're going to be bringing in guest speakers, guest hosts this season on the Elevate podcast to even deepen this conversation even more. But right now, this seminar that I got coming up, this is going to be August the 19th. That's coming up is specifically for that group of people that have a burden in their hearts to leave a legacy for those coming behind them. So if that's something you're interested in, call the office.
You can reach us at 901-209-4015.
Yep, that's it. Call the office if you want to plug into that. It's filling up quick, but the interest is so high. I think I'm gonna have to do a second date. Okay.
Yeah.
But yeah, that's what's going on. That's also the two biggest things that's happening with P3 right now.
So again, we are so glad to be back for season 2. We have some awesome speakers or guest hosts lined up this season. It's going to be great. It's
going to be great. So tell the people how to find us, and we'll get out the way.
So you can find us on YouTube at Elevate Now Podcast. So make sure you go on, like, and subscribe. Our whole first season is out there already, and we'll be dropping season 2 right after it airs on 104.1.
That's right.
And then you can also reach us on Facebook at Elevate Advanced Financial Training. Yeah,
we're just going to start posting all the podcasts there in that community that already exists as opposed to creating a new page. So, yeah. So, guys, this has been a great first episode back on the air, back in the studio, back recording. We're excited to get to this information. I've been just being honest. Sometimes it's pressure to come up with the topics that we think people are interested in. So, anytime you got an idea, just fire us an inbox, a text, a call, or what is it? Hey,
shoot it to us.
Shoot it to us. We're glad to talk about it. If you know some interesting people that line up with the messaging that we're putting out there that we should have on as a guest, let us know. We'd be glad to reach out to them.
And because we want to talk about what you guys want to hear.
We do.
We can only talk about what we think you want to hear, but you can tell us exactly what you want to hear.
That's exactly right. So, y'all, we're going to get out your way. Hope you have a great week as always. Keep in mind, it's time to elevate.
Elevate fam! Are you a business or brand looking to get in front of an audience that's all about leveling up in life, business, and mindset? Then let's partner up. The Elevate podcast is now accepting sponsors. That means you can get your brand heard by a growing community of go-getters, creatives, and purpose-driven listeners right here on the show. Hit us up at elevatenowtraining.com.